Alright, so I wanted to make a quick video talking about the potential investments to make in this new environment with the coronavirus. And two potential sectors that I'm looking at are the gold silver mining stock um, area, and the other one is the oil and gas sector. Um, both being which they're both commodities. So I'm primarily um, if I'm bullish on anything right now, it would be commodities. Um, I'm primarily staying away from, assets I find to be overvalued. A lot of assets are priced based on a coronavirus economy, and a lot of commercial real estate, residential real estate, um, and potentially U.S. equities um, could plummet, as a result of, you know, as a result of all this, So I'm looking to not only preserve capital, but to grow it. And the first sector I'm looking at in order to do that is the gold and silver mining stocks. Primarily because, from a macroeconomic standpoint, I feel as though demand for everything except um, real money, which is precious metals, gold, silver, demand for everything except for real money is going to plummet. Um, Not only between the unemployment, um, people. There's the fear factor, the unemployment factor, um, the inflation factor, which is the biggest, and I'll go over that more. But the only thing that we're supplying more of right now is money. All goods and services the supply of all those are being constrained as a result of everyone being told not to go to work and all the measures being taken for the safety. Um, the supply of goods and services is going to collapse um, more than demand. Demand is permanent. It's kind of like gravity. It just always is there. It's why if you build it, they will come. That phrase. It's why that applies. Like people, there's a definite demand for goods and services. It's just what can people afford, And so that it's more about the supply than the demand, And the price will just reflect that, based on the limited amount of resources we have and the amount of currency, And right now, um, currency is being printed at a rate that is unprecedented, and as a result, I'm expecting very heavy inflation. Commodities have had a rough decade, the last decade, and this environment could benefit them as there's going to be much fewer producers of just everything, um, and there's going to be a lot more consumers. So if you're on the supply side of that, of what people are going to actually be consuming, you could be on the beneficial side of that. So I'm looking for investment opportunities um, in this new environment, and if you're in the younger generations, you can afford to take some risk, and the mining sector has an inherent large amount of risk. Um, Mining is a horrible business, just in general. Um, it's expensive, it's risky. You have to, there's a limited amount of metal you can get out of the ground for any given mine. You have to explore, find more. Um, the very labor intensive, very energy intensive. But it's my opinion that you know both labor potentially, but more so energy is going to be cheaper. And that's an input to the gold and silver mining sector, a huge part of their expenses is energy, and energy costs are probably going to stay on the lower side for the short to medium term. So that's going to benefit them in terms of their expenses. I am of the opinion that I'm expecting stock prices to follow earnings in the long run. And what I'm doing right now is I'm asking myself, who's going to earn more money in 2020 than 2019? And when you ask yourself that question, like, you realize that there's probably going to be very few. You know, the list of people, individuals and entities, governments, corporations that make more money in 2020 than 2019, you know, very small percentage. And so I'm spending a lot of my time thinking and contemplating what those companies and or sectors would be. Precious, gold, silver mining has the potential to explode in profitability this year and the coming years due to the fact that the world is going to slowly catch on that interest rates are never going to rise again in the Western world, and they're going to catch on to how bankrupt these governments are, these countries, and all these measures being taken for everyone's safety, and all the financial easing, and all the responses by the central banks and governments to bail everyone out and to make everyone whole, or try to. No one's asking who's going to pay for it, and it's everyone is thinking with their feelings and wanting to look good and have swift, good politics, especially on election year. It's going to be a competition of who can look good, and good politics is always bad economics because people want a quick fix. People want a handout, and they always want the bad long-term economics, and at least the average voter, and that's what you have to be worried about in terms of democracy, and so, if 51% of people decide, that free stuff is better than freedom, then you're stuck with free stuff, and then you get to witness your economy and country collapse. So democracy is very risky, and socialism's getting more and more popular than ever. Neither political party is showing any restraint in that regard. Um, when the Democrats get in power, they might end up raising taxes on the rich, but it won't be nearly enough to pay for everything we've spent and borrowed already. You could tax everyone 100% of their earnings, assuming they still made as much, and you wouldn't even make a dent into what we spend. So that's why I'm looking in this sector. Is I feel as though we're basically on the Titanic, and the only life raft is real money, because earnings are going to be obliterated. People's incomes are going to be obliterated, except the government workers, of course. And a lot of money is just going to be printed with no underlying economic activity to finance it. And when that happens, you get insane stagflation, which is a combination of heavy inflation, which is the loss of purchasing power in the currency, and you get restricted economic growth, which means that your likelihood of getting raises, or finding prosperous jobs is low. You can kind of look at Japan for an example of this. They've had this going for a few decades, or even in the United States in the 70s. The 70s is a good example to look at for what I think this coming decade will be like. Heavy inflation, and limited economic growth. The 70s were buffered by an increase in people's wages and incomes, and I'm not entirely convinced that's going to happen this time, because when you have this many desperate unemployed people, when you have this high of supply of potential labor, it's hard for the price to go up. I mean, look at China, and India, when you have 1 billion people, the supply of labor is so high that laborers have no leverage, just fundamentally, and so labor stagnates. And that could be coming worldwide, which is very scary. It means that hard work's not going to really pay the way that it used to, and that, social unrest is going to be fueled from all sorts of corners. The wealth divide is potentially going to increase even greater than ever, but this may seem like tangents, but it's extremely relevant to understand the macroeconomic picture and the overall picture to see why I believe, prices could change in the future for certain stocks, commodities, and that creates investment opportunities. So, first off, here looking at the gold and silver mining stocks. I ranked these in order based on how appealing or how strong they are on the fundamental side, I guess I should say. The likelihood, I guess, that they'll go up, or how just the attractiveness of the investment. I ranked them by, and I combined, a lot of some of the measurements you see here, but I'm primarily sticking to the Western Hemisphere, but most miners are Canadian based, so that's where that's just, I didn't seek out Canadian companies specifically. That's just how it worked out. And in my mind, investment wise, I see Canada and the US as pretty much the same. So you have columns for, I'm showing the industry. So most of these companies specialize in either gold or silver. There's more gold producers than silver producers. Silver is generally the production and usually the byproduct of trying to specifically mine for other metals. But I show the annual dividend, the share price, the annual dividend, the dividend yield, earnings per share, dividend payout, book value, and I since have found this on Yahoo Finance somewhere, and I think under the statistics. But at the time, I didn't know it existed anywhere else, and so I thought I invented it, but maybe I didn't. But the price over BV is price over book value, and basically, what I wanted to calculate was, if you look at U.S. stocks, like, the book value of all the stocks is way lower, most stocks, of the price, because we've had 0% interest rates for 10 years. Savings accounts don't pay anything, so the only game in town, everyone is just this endless search for yield, so the only game in town is stocks and real estate, so we've created a real estate and stock bubble, but especially in the United States and the Western Hemisphere more so, and it's not so much that these companies deserve to have these stock prices, it's just that they're being bid up as being the only game in town, and the central banks have done this almost on purpose, and when the interest rates are zero as a result of how bankrupt the country is, the debts are too high to service any higher interest rates, but the results of those 0% interest rates is creating these asset bubbles, which is the primary cause of the increase in the wealth inequality, is primarily the rich that own these assets, but when you look at these assets, and you compare their book value to their stock price, they're just astronomically overvalued. I mean, Amazon should not be $2,500 a share. Netflix shouldn't be, $470 a share, whatever it is. Anything from Lockheed Martin to, you know, even when we go to the oil sector, we'll see like ExxonMobil. Um, the U.S. companies tend to just be way overvalued, and it makes it unattractive to buy in at these prices. But when you get into sectors like the gold and mining stocks, you realize that um, they don't have that insane valuation making them overpriced because they're just not on anyone's radar. And a lot of people who manage money for a living, you know, they consider these investments to be archaic or too risky or just, they're just not on their radar. And you almost never see people on mainstream television talking about this sector, you know. Um, and so the price over book value is basically, in my mind, what the performance would be had if you bought now and tomorrow, or eventually the price reflected the current book value. Um, so basically, in my mind, all of these even show a lower book value than their share price. You look at this column K, and column F. All of them are less than the share price. Meaning that they've been bid up higher than they really should be. But this is nothing compared to like some of the other sectors you could see. So, um, so it's not as big of a concern, but I thought it was interesting to look at because you can see that some of the stocks are better deals than some of the other stocks. Um, when you see an 80.4%, you're seeing that the book value is 80% of the share price, which means that if this is what it should be priced based on the evaluations, and this is what the market has the share price being, you're not overpaying that much compared to if you were to look at this with some of the American companies right now. If these would be in the triple digits, 300%, 400%, especially some of the tech companies. And so you're just really overpaying. But here not so much the case. So I thought that was a very interesting metric. Profit margin was very important to me because if they're able to make a good profit at current or past metal prices, their profitability when prices rise and their expenses decrease is going to be crazy. So that was a very important metric for me to compare. So I wanted to, so I listed that out. Um, Barrick Gold has the highest profit margin, and the second place was Newmont Mining. So in terms of the fundamentals and safety, I basically recommend these top three. Yamana Gold, Barrick Gold, Newmont Corp. Um, if you're looking into if you're looking to get into this sector, I especially recommend Yamana Gold. That's my favorite right now. Especially they have increased their dividend, this year, and who the hell else is going to be increasing their dividend? Very few people. So it's a very bullish sign that they've increased their dividend. They're confident in their earnings going forward, and they should be. So and I've included some other miners down here that I do own a few of these, and I don't think they're a bad idea to speculate on. Especially the silver companies. Silver has more upside than gold, and so the miners have more upside, but they also have more downside. You know, not as much as normal because the gold to silver ratio is just historically out of whack. It's like still over 100, and historically it like averages like 40. So um, what we're gonna so I put them there as like speculative, if you want to speculate. I think they're good vehicles to do so. So now I wanted to show the oil and gas sector. I gotta fix. Oh well. So I wanted to look at a few companies from a variety of countries. I wanted to diversify where I looked in terms of countries. And it was really interesting to me as I've been finding that Russian companies are very undervalued. Um, Regardless of your political like feelings or whatever, and I mean, how can any of us even know anything about Russia? I feel like all of our news from there and everything, like, what do we know, I feel like they could be in just, poverty and despair, or they could be thriving, and we really wouldn't know, So it's hard to know, other than based on what these publicly traded companies have to report, because they're publicly traded companies, and based on the financial fundamentals, you know, um, if you look at the price over book value, you know, these companies have higher book values than their share prices. These Russian companies, and even Royal Dutch Shell in the Netherlands. To have a higher book value than your share price is unheard of in the U.S. equities, and I thought that was worth pointing out. Um, I included profit margins here as well. Their dividend payout. The dividend payout ratio, column I, is important because this shows how much they can afford the dividend they're paying. And I, you know, this is very alarming. When I see even these, when I see triple digit, when they're paying out, they're basically, see, this is their annual dividend and their earnings per share. So the amount of earnings that, for each share you own, that's the amount of earnings that you have claim over, pretty much. And these are the dividend costs, which they're paying out more in cash dividends than they're earning for each of your shares, which shows they have like no money left over to reinvest in their company, and if they are, they're taking out immense amount of debt. It's just very concerning. So I would typically stay away from, I've ranked these in terms of their appeal, and I've ranked these as the least appealing, largely due to their price and how they just can't afford to pay out their dividends. In my mind, when I see stuff like this, I feel like they're bribing their investors with dividends, that they can't afford. So take a look at this if you're interested. You know, the I'm going to be doing more charts like these in the future and refining, the aesthetics and the useful information and just everything like that. But um, yeah, let me know what you guys think. I'll try to do, these numbers are obviously going to be outdated by the time you watch this video, but I think it just gives a general guideline and exposure to some of the sectors that I'm looking at right now in this new environment. That, you know, it's not just the virus, but the government's reactions to the virus. That's primarily what it is. All right.